is run by a bunch of investment bankers, and Morningstar's tools can help make it.
I'm here with Paul Justice, Director of ETF Research here in Chicago. So Paul, last year, Canadian ETF providers launched a bunch of covered call strategy ETFs, which track a narrow segment of the market, something like Canadian banks, utilities, and actually they're doing quite well with over $1 billion in assets under management. So my question for you is, do you have any advice for investors who are considering investing in covered call ETFs or are already invested?
Sure, I'd say keep your expectations in check. You're really getting a unique investment vehicle here. What it really appealed to, I think, was people who were looking for extra yield because of low interest rate environment, low dividend yield environment. It was difficult to come across that extra income. Covered call strategies generate more income than a traditional equity strategy. So that was certainly appealing, but there is a cost to getting that extra income.
Okay, and is there a certain market condition where these really excel?
Sure. So generally you're going to do really well compared to the market, say if it's a range-bound market. So fairly flat returns, maybe mildly up. You'll do well with a covered call strategy. Really what you're doing is you're giving away a lot of the future upside of your investments. You're selling that away by selling calls. So you'll get the money for those. Now if the market, if it decides to go into a large rally, much like we've had here in recent months, chances are your returns are going to be capped in the near term. So you may have a maximum 10% gain on the portfolio in exchange for getting that income for when you're in flat or down markets.
Okay, and I remember John Gabriel, ETF strategist on your team, wrote an article about the covered call strategies talking about volatility and how good volatility is for them. Can you elaborate on that?
Sure. So really an option becomes worth more when markets are more volatile. Let's say, you get into a contest with somebody where you've got two outcomes, okay? Maybe the market goes up by 10%, maybe it goes down by 10%. Now a rational investor is still going to say, it's still worth only $1 because I have even odds on it going either way. But if we expand those ranges out and say it could go up 25% or down 25%, well, that's a scarier proposition. I'd love to make the money on the upside, but on the downside, I may be hurt. It's those expectations that make options, this rational decision to stay away from that downside risk, more valuable in times of volatility. So in a volatile market, you sell the call options for a lot of money. So that's a good thing for you.
Okay, and what should investors look for if they're interested in investing in these ETFs, whether it's a covered call strategy from BMO or XTF or Horizons? Anything specific?
Well, really what you want to look for is give a comparison of what the historical yields have been, and be sure not to extrapolate that to mean exactly what that's going to be in the future. You have to moderate the expectations to say what percentage of the portfolio are they willing to sell out in the future? What are we going to cap our gains at? How much gains have we realized in the past? Is that going to be an indication of how much my income may fall off? Because each one of these are going to have different exposures to equities and different amount of calls that they're willing to sell.
Great, thank you.
My pleasure.